When it comes to borrowing inside your SMSF, the loan-to-value ratio is everything. Most lenders cap SMSF lending at 70% LVR, but do you know what that really means for your property strategy? In this video, we break down the 70% rule, how lenders apply it, and what you can do to maximize your borrowing power. Let's dive in.
All right, let's talk SMSF and property. If you're using your self-managed super fund to invest in real estate or even just thinking about it, there's one rule, just one, that you absolutely have to get your head around. It's that important. And look, I know this might sound a little dramatic, but it's true. For an SMSF, a single number can literally be the difference between a rock-solid retirement investment and a really costly mistake. So what is this magic number? It's what we call the loan-to-value ratio, or as you'll always hear it, the LVR. This is the absolute bedrock of SMSF lending. Honestly, if you're serious about this stuff, understanding LVR is completely non-negotiable. Okay, so let's get into it. We'll start with the basics, just to make sure we're all on the same page. What exactly is a loan-to-value ratio? Well, in simple terms, it's just the slice of a property's value a lender is willing to lend you. The rest of that pie, that's your deposit, and it has to come from your SMSF's own funds. You can really think of it as a built-in safety buffer, not just for the lender, but for you too. Theory's one thing, right? But let's make this real. Let's run through a quick example. Imagine your SMSF has found the perfect commercial property it wants to buy. So the math is actually pretty simple. Let's say the property is valued at $750,000. If the lender's LVR is 70%, they'll loan you $525,000. That means your SMSF has to come up with the other $225,000 for the deposit, plus, all the other costs like stamp duty. And right there, that single calculation tells you whether this property is even in the ballpark for your fund. Okay, so now we get what an LVR is. But in the very specific world of self-managed super funds, there's one LVR number that you'll hear about over and over again. It's basically the golden rule, the 70% rule. Yet, 70%, that's the magic number. For almost every lender out there, this is the absolute maximum they'll lend for an SMSF property loan. It's not just a guideline. It's a number that basically shapes the entire game for SMSF property investors. And this is where you really see the difference between a normal home loan and an SMSF loan. For your own house, you might be able to borrow up to 95%. But with your super? Nope. It's generally capped at 70. That means you need a much, much bigger deposit, at least 30%. And why so strict? It all comes down to one thing: protecting your retirement savings. You've got to remember, the regulators and the banks, they look at your SMSF as a retirement nest egg first and an investment vehicle second. So that 70% cap, it's not there to frustrate you or hold you back. It's there as a safety net to protect the whole fund from taking on too much risk. It's all about making sure one property investment doesn't put your entire retirement in jeopardy. And this leads us right to the heart of the matter, the big trade-off that comes with this 70% rule. It's kind of like two sides of the same coin, and as a trustee, you really need to understand both. Probably the best way to see the upside of this rule is to stress test it. Let's see what happens when things go south, when the property market takes a hit. We'll walk through a quick scenario. Okay, so picture this. Your fund buys a property for exactly $1 million. With that 70% LVR, your loan is $700,000. This means from the moment you sign the papers, you have a $300,000 equity buffer. That is a huge safety net right from day one. So you've got this big, comfortable cushion between what the property is worth and what you owe. But what happens if the market gets shaky? Let's say prices suddenly drop by a pretty steep 20%. Now what? Well, even after that massive $200,000 drop, the property is still worth $800,000. And your loan? That's still sitting at $700,000. So guess what? You still have $100,000 of positive equity. That mandatory 30% deposit, that buffer, it just did its job perfectly. It saved your fund from going underwater. That is the protective power of this rule in action. And that is the trade-off right there. The 70% limit gives you incredible security, which is great, but it also means you have less leverage. An investor using that same deposit money outside of super could probably buy a bigger property, maybe even a couple of properties, and shoot for faster growth. It's the classic dilemma. Do you want more security or do you want more growth? So now that we know the rule and we understand the trade-offs, the big question is, how do you make it work for you and your fund?
This is where we move from just knowing the rule to using it strategically. Look, there is no one-size-fits-all strategy here. You've got to ask yourself some key questions. How much cash does the fund have? What kind of property are we buying, residential or commercial? What's happening with interest rates? And maybe most importantly, what's our risk tolerance and how far away are we from retirement? All of these things are going to shape what the right LVR is for your specific fund. And here's a really important pro tip. It's super tempting to throw every last dollar of cash in your fund at the deposit, but you shouldn't. A good rule of thumb is to try and keep about 5% of your fund's total assets in cash. Why? Because you still need to pay bills, maybe pension payments, and handle any unexpected surprises. Having that liquidity means you won't be forced to sell something at the worst possible time. Which brings us to a really critical question you should be asking. Just because the bank will lend you 70%, should you actually take it? The answer, of course, is that it completely depends on your fund, your goals, and your situation. Here's a slightly more advanced way to think about it. Instead of just looking at the LVR for one property, think about the LVR for your entire fund. You might have one property geared to the max at 70%, but maybe you have another one that's completely paid off with no debt at all. Taking this big picture portfolio view lets you balance out the risk across all your assets. Okay, we've gone through quite a bit there, so let's boil it all down. What are the absolute key takeaways you need to walk away with?
Number 1, that 70% limit is your safety net. It's there to protect you from market downturns. Number 2, its whole purpose is to safeguard your retirement savings. That's always job number 1 for super. And number 3, your ideal LVR isn't just 70% by default. It's a strategic choice you have to make based on your fund's own goals and risk appetite.
So if there's one thing to take away from all this, it's this. Try not to see the 70% rule as a frustrating roadblock. Instead, think of it as a guardrail on the highway. It's not there to stop you. It's there to keep your retirement strategy safely on the road, guiding you towards building real, sustainable wealth for the long haul. And when you look at it that way, well, that changes everything, doesn't it?